Alright everyone, welcome to another video. It is officially the start of another quarter, so we're going to check out the market outlook for this last quarter. We're going to go over the S&P 500. Now, when you just take a quick glance, obviously we're still in this bear market here. We've had three very bearish days here where the open, or actually I should say three very bearish weeks. The open of each week is below the close of the previous week. Some people call that three black crows. It's like an old school Wall Street terminology, basically like a bad omen. Three very bearish weeks. That's a bad signal for the markets. And you can see the rising volume happening on this 3-week downtrend here, and all the indicators are showing some downside. We have a bearish cross here, and the RSI shows we could still have more downside on the weekly long-term picture. So things aren't looking very good, basically. You can see the price is near the 200-week moving average here. Let me highlight that. We could possibly find some support there, but there's really no reason to be bullish at all right now. We got the Russian war uncertainty. We got the Fed trying to kill growth to fight inflation, and inflation's still super high, so literally nothing looks good in the markets. There's no reason to be bearish, or no reason to be bullish, I should say. Now, I did mention that 200-week moving average, and I'm just going to highlight some moments in the past when SPY was looking extremely bearish, and we had some strong bounces at the 200-week moving average. Like the pandemic crash was one instance when we dipped below the 200-week moving average. That was a very swift crash in the markets. And the other two instances were further in the past, some very long-term bear markets. From the financial collapse you can see here, and the dot-com bubble, the Y2K meltdown, whatever you want to call it. Those were long-term bear markets where the price did dip below the 200-week moving average, as you can see. So this could be a crucial turning point, a make-or-break moment in the markets. The 200-week moving average, it has acted as strong support in a couple instances. It even acted as resistance a few times, and especially in these bear markets, when we dip below, you don't want to see that. That could lead to a long-term bear market. That's basically the only time that it has happened in the very recent past, except for this pandemic crash here. We quickly rebounded off the pandemic crash, just like we did a few other times in history at these taper tantrums that happened over the past, let's say, a decade or 12 years or so. It's hard to say if we're going to get a rebound here. Like I mentioned a second ago, there's really no reason to be bullish in these markets right now, but the markets do whatever they want, so you always got to watch out for these strong technical support or resistance levels. And I should mention, aside from these long-term bear markets that happened in the past when the price dropped below the 200-week moving average, other than that, within the past, let's say 12 years here, let me zoom in. Yeah, within around the past 10 to 12 years, whenever the price has reached the 200-week moving average, it has been one of the best buying opportunities within this time frame. And even in the pandemic crash, when the price dipped below, it was still a good buying opportunity. It swiftly returned. And I'm not saying it's a good time right now, because we have some strong downward momentum going on, and the macroeconomic environment's bearish. But it's still important to look in the past at probably the best buying opportunities you've had in the past 12 years were at this 200-week moving average. Just something to point out there. Now, let's not argue that we are in a downtrend. This is obviously a downtrend on the daily candles here. It's been doing this since last November. I believe that was the peak there. The Russians started invading and everything started crashing, basically. But on the very long-term time frame, technically speaking, we are in a bull market. We're still within this bull market price channel, and this is a solid price channel. It's parallel, smooth price channel. We got a mid-bar like a lot of price channels can exhibit, and you can even see how this mid-bar kind of corresponds with the 200-week moving average very often, where you can see the bounces in the past that happen at the 200-week moving average and this mid-bar of this very long-term bull market price channel. So the very long-term picture is bullish, but right now we are in a swift downtrend that's going on. So where are we going to bounce? Are we going to come all the way down to the bottom of this price channel just like we did in the pandemic? Or are we going to find some bounces at some technical Fibonacci levels or somewhere in this thing, maybe a previous high? Let's zoom in and check it out. Alright, now we're zoomed in here on the daily candles, and I mapped out the Fibonacci levels that is basically for the current trend here from the low to high. And first thing I'm going to say is where the analysts are calling for the SPY to catch a rebound or a bounce or at least some sort of friction is at this 3,400 level on S&P 500 futures. This is where all the analysts are calling for, and that would correspond with a textbook bounce off previous highs and an uptrend in this 12-year uptrend that we've been in that I just mentioned. There's also a small previous high I want to mention right here, and the price is just chilling at it right now, so you want to watch out for maybe some bullishness here. I'm not planning on it because we're just falling like a rock, but definitely watch that technical support level as well. But this 3,400 level, this is where the analysts are calling for a bounce. And if you follow the Fibonacci levels, the 50% Fibonacci level is a really strong support slash resistance level, and we're getting close to that. Definitely watch that technical support level as well. The Fibonacci levels hit pretty hard very often, so you can possibly get a short-term trade. I doubt the market will rebound until the Fed calms down on the interest rates, but watch that $3,500 level as well. That's the 50% Fibonacci level. If there is, and only if I'm saying there's any bullishness or relief in this massive downtrend that we're in, it should happen at these levels that I mentioned. These are the strongest support slash resistance levels that we have in the near term, so keep an eye on these. And don't forget that 200-week moving average is somewhere right around this zone. And that's basically it for the market outlook for the start of this new quarter. I am starting a live stream in pre-market every morning. I'm still working it out just like I'm working out my YouTube channel, but I do have multiple charts on the screen. I got all the pre-market runners. I try to catch them as they happen. I got a little volume screener that I use. So watch that if you like to trade those low-price penny stocks in pre-market. And other than that, definitely like the video, subscribe, hit the notification bell, leave a comment about any questions, suggestions, anything you like, and I'll see you on the next video.